Everybody loves the S&P 500. Even the greatest investor of all time, Warren Buffett, has said that the average investor should just buy a low-cost S&P 500 index fund and forget about it. But what if I told you that there is a simple two-fund combination that has beat the S&P 500 in both returns and income? And no, I'm not talking about some obscure strategy. This is as simple as buying SCHD and SCHG. Today we're going to be diving into these two ETFs that when combined have outperformed VOO in total return and dividend yield. So what exactly is VOO, or ticker VOO? Well, here's a quick overview. This is an ETF that tracks the S&P 500, which offers broad US market exposure and has a very low expense ratio of 0.03%. It's extremely popular and often the default ETF for many investors. As I mentioned at the start of the video, even Warren Buffett has said that for the average investor, an index fund like VOO might be the best choice. After all, this ETF does have great strengths of diversification, low cost, and stability. However, that doesn't change the fact that this two-fund portfolio has outperformed it since inception. The first part of this two-fund portfolio is SCHD. SCHD, also known as the Schwab U.S. Dividend Equity ETF, focuses on high-quality dividend stocks, has had a relatively high yield historically of around 3 to 4%, and screens for quality and consistent dividend growth. Schwab themselves highlight that this is a simple, straightforward, low-cost fund offering potential tax efficiency. They also say that the fund can serve as part of the core of a portfolio, or even complement a diversified portfolio. The fund tracks an index focused on the quality and sustainability of dividends and invests in stocks selected for fundamental strength relative to their peers based on financial ratios. The second part of this two-fund portfolio is SCHG, also known as the Schwab U.S. Large Cap Growth ETF. As far as the highlights go, you can see it's pretty much the same as SCHD for the first two highlights. However, in the third point, they say that there is simple access to large cap U.S. equities that exhibit growth style characteristics, and that the stocks are classified as growth based on a number of factors. As you can tell, SCHG heavily leans toward a growth profile where SCHD aims for dividends. SCHG is also fairly tech heavy. Going back to SCHD, we can see that the top holdings of this ETF are Verizon, Coca-Cola, ConocoPhillips, Altria, Lockheed Martin, Cisco Systems, Home Depot, Texas Instrument, Chevron, and AbbVie. As you can tell, the companies that make up this ETF are solid blue-chip companies that pay stable dividends. On the other hand, SCHG's top 10 holdings are as follows: Microsoft, Nvidia, Apple, Amazon, Meta, Broadcom, Tesla, Google, followed by Google, and Visa. For clarification, Google is listed twice because there are two different classes of shares. Also, before I get too far into the video, I would like to remind you guys that it would be greatly appreciated if you would leave a like and subscribe to the channel. So why would an investor want to use this two-fund portfolio versus the S&P 500? I would say that the first reason is that SCHD and SCHG offer a very clear approach when it comes to investing. SCHD simply aims to invest in stocks that offer quality and sustainable dividends. SCHD acts as the half of the portfolio that would act as a rock during turbulent times. SCHG, on the other hand, focuses on fast-growing companies. During a bull market, SCHG will seek to capture more capital gains than SCHD. Also, as I mentioned earlier in the video, a portfolio with a 50-50 SCHD-SCHG allocation has historically outperformed the S&P 500. Not only has it historically outperformed the S&P 500, but it also offers a higher dividend yield. As you can see on the screen, the S&P 500 Vanguard ETF has returned 11.45% per year since 2011. Meanwhile, SCHD has returned 9.32% per year on average, and SCHG has returned 14.05% per year on average. If you had a 50-50 allocation of SCHD in your portfolio starting in 2011, your average return per year would be around 11.68%. Now you might be thinking to yourself, well, that's not much better of a return than the S&P 500. And you would be correct, but it makes a big difference over a long time period. As you can see here on the screen, if you had invested $10,000 in the Vanguard S&P 500 ETF back in 2011, the end value today would be around $43,600. However, if you had put that same $10,000 in 2011 into this two-fund portfolio, you would have made an extra $3,000. To be exact, that $10,000 would have turned into $46,607.18. Not only that, but this two-fund portfolio also has a dividend yield of 2.16% at the time of making this video, whereas the S&P 500 only has a yield of about 1.28%. Anyways, that's just about all I have for today's video. Let me know what your ETF strategy is down in the comments and if you're holding SCHD or SCHG in your portfolio. As always, thank you all for watching and see you next time.